But we are certainly a bit more mindful in terms of the differentiation within the credit markets. You touched on a very important point in terms of the idiosyncratic issues. And as you go down in the high yield markets, it's very important to be mindful of the idiosyncratic stories that are going to emerge, especially with slower growth and some of the regulatory pressures. But overall, looking at the regulatory side, looking at the fundamentals of the sector, we are positive on the sector in terms of the Chinese real estate high yield. But a lot of these are pointing towards a more diversified, stronger developers as the area where you would actually focus from an investment perspective. So you do have to be mindful of some of these noise factors which are emerging.
Okay, and what about the link drawn with the BOE considering negative rates down the road? What that would mean for the LIBOR against which a lot of rates are benchmarked? And I don't know how much is Asia's credit exposure linked to that, but even so, what do you see to be the trickle-down effects of that if that were to be a reality sooner rather than later?
First of all, the BOE keeping the room or the door open for negative rates, I think it's a function of the overall impact of not just COVID, but also to some extent the complexities of the Brexit and a potential risk from a no-deal Brexit. So obviously there's a lot more of the room that BOE needs in terms of providing the cushion for the economy. From a exposure standpoint, in terms of the structure, you typically have floors for the floating rate. So it is not that big of an issue. And when you come specifically to the capital markets and Asian credit, close to 98 or 99% of the issuance comes in the fixed rate. So you don't have the floating rate in the credit markets. That's much more of something that you would see in the bank loan structure. So there will be obviously some impact, but I don't think that's something which drives the markets from here. Obviously, there's a broader theme around low rates in this world, which one needs to be mindful about. And I think that's a bigger issue the world faces. It's not just negative rates. It's also how much of the global debt stack actually yields less than 50 basis points or 1%. It's probably 50 basis points. It's close to $35 trillion of debt stack. Question remains, where do I find my income for the portfolio?
Where do you, Neeraj?
Well, Asia is a good answer. And I think within Asia, I would argue, in fact, China and the opening up of China, the integration of China in the global capital markets, the recent announcement from FTSE, I think these are important developments in terms of the shift in market structure. Again, if I draw a simple line around 2.5% yield in the global fixed income, the reality is more than 50% of that is actually in Chinese assets, onshore and offshore, and mostly onshore. And the world is underinvested. Whatever way you look at it, the overall exposure in China fixed income for global investors is still less than 3%. And it has been ticking higher in the government bonds closer to 9%, or policy banks now closer to 5%. But overall, I think Asia is a part of it and the answer in terms of where you find your income, if not the whole answer.